Many people wonder what happens to their belongings and financial assets after they pass away, especially when it comes to taxes. It is a common concern that can feel overwhelming, but understanding the basics can provide peace of mind. For federal estate tax purposes, almost all property you own or have certain interests in at the time of your death generally counts towards your gross estate. This includes a wide range of assets, from real estate and bank accounts to retirement funds and even life insurance policies. The key concept here is the gross estate, which is a very broad valuation of nearly everything an individual owned or had a controlling interest in just before their passing. This goes beyond what passes directly through a will. It encompasses readily identifiable assets like your home, other real estate, personal property such as vehicles and artwork, and financial investments like stocks, bonds, and mutual funds. It also includes retirement accounts, such as individual retirement accounts and 401k plans. Even certain life insurance policies are included if you own the policy or had significant control over it. Additionally, some gifts made within 3 years of death can be brought back into the gross estate calculation, as can assets held in certain types of trusts you may have established. The government aims to get a comprehensive picture of your financial standing to determine if your estate meets the threshold for taxation. To begin understanding your potential estate tax situation, it is helpful to start by compiling a comprehensive list of all your assets. This list should include property solely in your name, assets jointly owned with others, and any property held within trusts. Once you have a clear picture of your assets, consulting with an estate planning attorney or a qualified financial advisor is highly recommended. These professionals can provide personalized guidance and help you estimate your gross estate accurately. It is important to remember the federal estate tax exemption amount, which is indexed for inflation and is quite substantial for most individuals. This exemption means that the vast majority of estates do not actually owe federal estate tax. Additionally, there is a valuable provision called portability, which allows a surviving spouse to use any unused portion of their deceased spouse's federal estate tax exemption. This can significantly increase the total amount that can be passed on tax-free to heirs. Proactive estate planning helps ensure that your wishes are honored and can minimize potential tax burdens for your loved ones. Understanding what constitutes your gross estate is the first vital step in creating a thoughtful and effective plan for your legacy.